Welcome to the ultimate guide to decoding your salary. Today, we're cracking the 2026 salary code for Indian employees, focusing on the massive gap between your CTC and what actually hits your bank account. If you've ever looked at your paycheck and wondered, where did the rest of my salary go? You've experienced the math of disappointment. We're here to explain why this happens, especially with all the new regulations. First, let's deconstruct the biggest myth in Indian payroll, the cost to company, or CTC. Crucial concept number one, CTC is not your income. It is the expense the company incurs to employ you. This includes contributions that never touch your hand, like employer PF and gratuity. These are your hidden deductions. The employer's contribution to Provident Fund, the statutory gratuity provision of 4.81%, and company insurance premiums. These all come out of the CTC before it even becomes your gross salary. Now, let's talk about the biggest game changer hitting the 2026 salary structure, the new labor code and the 50% basic pay mandate. The new law requires your basic pay to be at least 50% of your total CTC. Why does this matter? Because Provident Fund and gratuity are calculated as a percentage of basic pay, forcing a massive shift towards long-term savings and away from immediate take-home pay. Visually, this means your salary structure shifts from allowance-heavy to basic-heavy. You might see a lower in-hand salary initially, but your retirement corpus grows much faster. To understand the final number in your bank, we need to clearly separate gross salary and net salary. Gross salary is what you get after the employer's non-cash expenses are deducted from the CTC. It's the total cash component paid to you before your personal deductions. Net or in-hand salary is the final amount. This is your gross salary minus your personal statutory deductions, primarily your income tax and your own 12% employee contribution to the Provident Fund. The FY 2025-26 tax regimes also bring key updates you need to be aware of, especially if you opt for the new tax regime. One major change is the increased standard deduction. In the new tax regime, this deduction jumps to 75,000 rupees, making it more appealing for salaried individuals. Due to the enhanced rebate and the new standard deduction, income up to roughly 12.75 lakh rupees is effectively tax-free in the new tax regime for 2026. This is a game changer for mid-level earners. Let's break down a few other critical components that drastically impact your take-home pay. House rent allowance, or HRA, is calculated as 40% or 50% of your basic pay, depending on your location. The exemption amount is key to lowering taxable income, especially in the old tax regime. The new regime does not offer HRA benefit. Variable pay, like performance bonuses, is taxed like regular income. Since they are often paid out as lump sums, they can sometimes push you into a higher tax bracket, making them feel smaller than the promised amount. So how do you fight back against the math of disappointment and maximize the money that ends up in your wallet? Look into flexi-benefits. Tax-exempt components like meal coupons, fuel reimbursements, and the employer contribution to NPS under 80CCD2 are brilliant ways to receive value without incurring immediate tax liability. Use an updated tax calculator to run side-by-side comparisons of different CTC levels, 10, 20, and 50 lakh rupees, across the old and new regimes. You need to visualize the difference to make an informed choice. Finally, the most important step, mastering the take-home negotiation strategy. If immediate cash flow is key, prioritize salary components that yield higher in-hand pay. If long-term wealth matters more, embrace the higher basic pay mandate for better retirement benefits. Know your math and negotiate your worth.